welcome to How to Value a Startup. We're going to have a poll come up just to find out where people are actually in, where they sit into it, so I can actually tailor the presentation to the audience there. So a little bit background about myself. My name is Adrian Bunter. My day job is I'm a corporate advisor with Venture Advisory. Previously to that, I was with PricewaterhouseCoopers, and I'm also an angel investor with Sydney Angels. I have a number of non-executive director roles on a couple of listed companies as well as some private companies, and I've done a range of investments. I've done over 40 angel investments over the last 10 years and advised on over 100 completed M&A deals, sales and capital raising transactions. So that's a little bit about myself. Now, a little bit about Sydney Angels before we get into the main presentation. Sydney Angels is a membership-based organisation established in 2008. We've got over 85 angel investor members. We run a team-based investment process, which means the members actually work together to invest in due diligence, in selection, and then managing the investments ongoing. We have 2 sidecar funds that sit alongside Sydney Angels, so they co-invest alongside with the angels. We typically invest in startups that are raising their first post-family and friends rounds. The round sizes are normally $200,000 to $600,000, and quite often we are investing with other co-investors as part of that. So you'll see that quite often on that. So Sydney Angels and the sidecar fund then results in other co-investors coming along to that investment as well. One of the things we look to do with Sydney Angels is we're growing our investments, but we also make sure because we're the first investors that come into the round, we often get other investors to follow on over the period of time. So Sydney Angels as a group has invested $29 million, but we've also catalysed more than 10 times that from other investors as they've come into the same rounds and also follow-on rounds down the track. And that investment's gone into 73 startups. We often get asked what's the investment process that actually gets run. So the process we run generally results in 6 to 8 new investments per year. Deal applications can come in at any time. We take them all online. Generally, within a cycle, there's 30 to 50 applications that come through. We run 6 cycles per year, which roughly is about every 6 to 8 weeks. The committee and some members review those that come in on a weekly basis. The best 6 of those then go into a deal screening meeting. They then get screened by a range of members. They then get ranked, and the best 3 of those go through to a full members meeting. And then out of that 3, 2 to 3 normally get due diligence started on those, and then 1 to 2 of those actually get an investment out of it, which, as I said before, has resulted in 73 investments in the portfolio as at the end of September. We filter the applications quite rigorously. I think any of the startups that are watching this will know that raising investment is hard and it's actually very competitive. What you'll actually see with Sydney Angels, of the applications that come through, about 3 to 4% actually receive an investment. And if you actually get through to a members meeting, you've generally got a 1 in 3 chance of getting an investment. But you will also have received a lot of advice and coaching on the way through that process. We've invested in a very diverse range of startups. They do tend to be technology focused. This slide shows all the logos of the companies that are there. You'll notice a large number of them have RIP in there. There are startups that have failed. It's obviously high risk. We would expect that half of the startups, so generally you expect about half of the startups that get invested in would fail. So there's a lot less than half there that are rest in peace. So the process is actually going quite well at this point in time. Now, we'll get into the main part of the presentation, which is how to value a startup at the Spark Festival. So what we're going to talk about today is whether or not the valuation, is it art or is it science? And talk a little bit about what is value. We'll go through and talk about some valuation measures. And we'll also have a look at some of the things that actually impact valuation and how startups and investors can actually think about it. Just remind people just to enter the poll. We're going to close off that poll just so we can get the information about who's in the audience. So if you haven't entered the poll, can you please enter the poll? Right. So what is fair market value? Fair market value is this is a fairly standard answer response, which is the price at which a willing but not anxious vendor would sell, and at which a willing but not anxious purchaser would buy. Now, this assumes a couple of things. The important things, the underlines, are willing but not anxious. So if you are a vendor, i.e. the startup, and you're desperate to receive the money, you will then generally accept a lower price than if you've got more time in which to actually negotiate a transaction. Same for a purchaser. If you're an investor and you're very anxious to make an investment and get into it because it's a highly competitive deal, you're more likely to actually pay a higher price. Now, the other thing that's important to get a fair price and a market value is it assumes that both parties are knowledgeable. This is actually quite difficult because the founder actually has a lot more information about their business than what the investor does, and therefore the investor needs to do due diligence on that investment before they actually make the investment. One of the things you'll find is that investors who rush in and do a very, very fast deal without doing any due diligence can often overpay and often make a bad investment. And likewise for the startup, a fast investment can sometimes result in an investor who's not used to investing in startups, doesn't have full information, and therefore can actually prove to be a difficult investor in the future. So what are the things that actually determine price or value? Price is really a function of risk and the return, right? They're the two core things, and almost everything that we talk about in the concept of valuation will fit into one of those two buckets of risk and return. So in effect, the price will go up as the risk goes down and the returns go up. And the vice versa, the price will go down as risks increase and returns go down. So if you bear that in mind, when you're actually looking at it, think about risks and returns for coming up with valuation. Now, there are broadly two ways of doing valuations. It's really based on the business potential, so you're looking at doing research and analysis. And the second one is really comes down to a negotiation. So it's what share of the company is the investor going to get, what share of the company is the founder or entrepreneur prepared to give away, and that's a direct result of the negotiation between an entrepreneur and the investor. So, as I said, it's a negotiation. So if you look at this chart, the company value, there's a point for a valuation where the entrepreneur will accept a certain minimum value, and there's a point where the investor will pay a maximum value. Now, if you get a scenario that's on this slide where the maximum amount an investor is prepared to pay is above the minimum amount that an entrepreneur is going to accept, you're going to effectively get a deal, and the price will be somewhere between those two numbers. Now, a lot of that will then depend on how the negotiation goes, how desperate it is, who wants the deal most. So if it's highly, highly competitive and lots of investors actually want it, it's more likely to skew towards the investor's maximum. If there's not a lot of investors, therefore it's more likely to skew towards the entrepreneur's minimum value. There are a number of scenarios where the positions on this graph are actually flipped around, where the maximum amount an investor is prepared to pay is less than the minimum amount an entrepreneur is prepared to accept. And in that scenario, clearly there's no deal because the investors hit their top. It hasn't achieved the clearance price that the entrepreneur wants to accept, and therefore can't actually be satisfied. Now, we talked about risk. Now, there are different stages which result in a change in the valuation of a business. So if you look at this, if you think about point 1 on the lower left-hand side of the chart, that's the point where it's really just a concept and an idea, and there's not much more than that. If you bring a team around it, you then get the talent risk. As a result, you start addressing the talent risk. When you start doing that, you're actually reducing some of the risk. You're actually addressing the people that are coming in. Once you've actually got a product in the market and you've actually got people buying it, you've started addressing the market risk. You've proven that somebody actually wants to buy the product and it can actually be sold. Now, that doesn't necessarily mean that the business is going to be successful and sustainable, because in the early days, a lot of companies will sell something for less than what it actually costs them to make. And therefore, it can be very easy to go and sell something for $1,000 if the real cost to manufacture that item is $2,000. that's actually a great deal for the person buying that item at $1,000. And depending on the item, they may not care whether or not the business actually survives or not, because they've actually got what they want. Now, when you then get to point 4 and you start addressing the business risk, this is when you've actually proven that you've got some idea around the sustainability of the business, that you've got a view that you can get to unit economics and profitability coming through. When you then start going to 5 and scaling, you actually get a much more valuable business. So as you go through, and you'll see it, as you address risks through it, the value of the business will actually increase because you're addressing those concerns. Now, the other key thing that's a big contributor to price, if you go back to basic economics, is supply and demand. And a lot of people actually forget to think about this. If you're a startup, you have to remember, when you're looking to raise capital, there are lots of other startups also out there looking to raise capital. So if you think about that as the supply of startups in the system, so as there's more supply, that curve will actually shift and the price will actually decrease. All other things being equal. If you then look at the demand, that's the investors who are looking to make investments in startups. In that kind of scenario, as more investors come into the system and there's more people chasing those investments, if there's not an increasing supply of startups, that will generally tend to push the price up as the demand actually increases. So you have to think about it from a startup's perspective, that when you're competing for investment, you're not just, when you think about competition, it's not just the companies you're competing with to make your business successful. You're actually also competing against all the other startups who are trying to raise capital and actually trying to chase the same investors that you're trying to chase. When we talk about value, and I'll use the words value and price interchangeably in this, it's important when you're raising capital for both investors and for startups to understand what valuation you're actually talking about. People should be familiar with the concept of pre-money value and post-money value. Now, it's actually a very simple equation. The post-money value is the sum of the pre-money value and the amount of money that's actually invested. So if we do a really simple example of this, the pre-money valuation, let's say it was worth $1.5 million. If you're going to raise $500,000, that's the money invested. Your post-money value in that will be $2 million. Now, the split in the shareholding as a result of this would be the investors coming in would have 25%, which is $500,000 out of the total of the $2 million, and the existing investors or founder and any other shareholders who exist already will have the 75%. Some people ask, what is it better to refer to when you're actually talking about valuation? The pre-money valuation is probably the best one to ultimately talk about because it's the number that's broadly fixed. The amount of money that you raise that comes from the investment might actually change. So if that's $500,000, your post money will be $2 million. But if you actually raised $1 million, your post money would go to $2.5 million. Now, lots of investors like to think about post money valuation and both pre money valuation because the post money helps them work out what percentage share of the company they're actually going to own at the end of the investment. But whichever one you use, it's really important to state what it is and actually work out your assumptions. So if you are raising, for example, on a $2 million post money, it's important to say that that's based on raising $500,000. But I would generally encourage people to talk about pre-money valuation when they're talking valuations for their business. Now, why is valuing startups so hard? There's lots of challenges in valuing young companies. If you think about it, there's no history, there's no revenues, especially if they're pre-product. Sometimes they're actually pre-product and they've got just an idea and a concept and a good strategy, but without actual real product out there. If they did have forecasts, because they have no historical information, they're quite rubbery forecasts. The unit economics, when people are doing it, if they've even done forecasts, are best guesses. They're not based on real world. They're not based on real scale. They're really based on what the entrepreneur thinks can be achieved. There's almost always going to be a future capital raising required. You don't necessarily know how much that amount is or when it's going to be. And invariably, it's a different amount to what you think it's going to be right up front. You've also got the unknown about when the exit is actually going to happen. So it's very easy to invest money. It's much harder to get the money back in and actually make a positive return. And then the other thing is, because a startup is based on an entrepreneur with a passion for what they're working on, they can tell a good story, and it's a personal entrepreneur. So people like to invest in people that they believe in, that actually have a passion. Therefore, they actually will overlook some of the other ones, the other items that they should be thinking about when they're thinking about making an early stage investment. So all of these things combined make it exceptionally hard to actually work out what a young company is actually worth. Now, we're going to put up a poll, and we're going to work out what the valuation of this company is. And we don't have that long to do it. So if you're there and having a look, and they've got some ranges there from less than $10 million up to more than $100 million. So if we look at this one, this is the financial services sector company. It's fairly early stage. It's predominantly focused on the US market. It's targeting millennial customers. Now, they don't have any revenue at all. The product has not been commercially launched, so it's generally not available to the public. However, it is in beta phase, and the expectation is that it will launch sometime soon. The business has got $6.5 million cash in the bank, doesn't have any debt. The whole business and everything has been developed over the last 3 years, and the business has raised a total of $10 million over the last 3 years. And obviously in that $10 million is included the $6.5 million that's cash in the bank. So now that you've got all that information, it's not a huge amount, but just at a high level, I want people to answer, what do they think the value of this business is? Is it less than $10 million? Is it between $10 and $30 million? Is it 30 to 60? Is it 60 to 100? Or is it greater than 100? So we'll just shut that off, and we'll get the results of that one before we then move on to another example of the next one. Just give a few seconds for those poll results to come through. Coming through. While that's happening, we might just move on to the next one, and then we can come back and quickly just reflect on that with the next one as well. So the next poll is going to be answering the same thing for another company, different set of facts, same valuation ranges. So this company it's got two businesses within it. It's got a legacy software business, which is a subscription, plus it's got a new wearables business. They're both focused in similar sectors. The legacy software business has $3 million in revenue. It's profitable. It's low growth, but it's a market leader. But it also has very sticky long-term clients. The wearables business, which has been built up over a couple of years, has got $7.6 million of revenue, which is made up of $6.4 million in product sales, $1.2 million in subscription revenues. It's currently loss-making, but it's got fast growth. And at year end, that subscription revenue was actually running at a annual recurring revenue of $1.5 million. They've got $5.5 million cash in the bank. Now, the legacy business is more than 10 years old. The profits that it generated actually funded the creation of the wearables business over the last 3 years. But the total capital that's been raised over the life of this business is $18 million. So again, same question. What do you think the value of this company is worth? Is it worth less than $10 million? Is it $10 million to $30 million? Is it $30 million to $60 million? Is it 60 to 100? Or is it greater than 100 million? Think about those final facts that are there. The summary. Think about the two. What do you think this business is actually worth? And we'll close this off. So now that one's been closed off, we'll talk about the previous example. So the previous example, interestingly, so the results coming up were 41% said they thought this business was worth less than $10 million. 43% thought it was 10 to 30. 13% said 30 to 60. 3% said 60 to 100, and 3% said over $100 million. Now, I think a lot of people are going to be very disappointed with this, and you probably shouldn't use this as your benchmark for your startup. But this business, as of yesterday, was worth $130 million. This is actually a company listed on the stock exchange called Doe, and we'll talk about that one. So now we'll move on to the poll results for the next one, and then we'll have a little bit of a discussion around the two and possibly why there are differences in here. So the poll results for the for this one says it's worth 38% say it's worth less than 10 million. Sorry, adjusted. 3% say it's worth less than 10 million. 44% say 10 to 30. 32% say 30 to 60. 18% say 60 to 100, and 3% say over 100. Now, this business is also listed on the stock exchange. It's actually, as of yesterday, worth $22 million, and it's a company called MGM Wireless. Now, two very different companies in those with the descriptions on revenues and progress, and two very, very different valuations. Now, I'm not going to say which one's right or wrong. Arguably, potentially, both of the valuations of those businesses are wrong. But I think if you think about those two businesses, the first one is obviously in the fintech sector, so it's highly attractive. It's focused on the US market, targeting millennial customers, and I think people believe there's going to be strong growth around that. Second business, because it's a legacy business, it's got an older business that hasn't had huge amounts of growth and actually small revenues. I think people are not seeing that there's strong growth potential around that. The wearables business is definitely harder because it includes hardware sales through it, and it's still loss-making. So I think people still have questions over the sustainability and what kind of growth that will actually get. It's quite a competitive market. So it's interesting just to think about how why things actually happen. We'll talk a little bit about some of those valuation changes as we go forward. And if you've got questions, you can put them up on the Q&A, and I'll try to cover off some of those as well. Now, value is a function of the cash out, the investment that's being made, how much money you get back in from the investment, which is the cash return, and then the time that's actually spent between those two. What are the return expectations? So where do you actually sit? So seed, the very early stage investors, so it's, seed investors, angel investors, are generally looking to receive 10 to 20 times return on their money. Venture investors really looking 5 to 10. I mean, arguably 10 times return on money across all of their investments is what they're targeting. And then private equity investors, 3 to 5. So what you'll notice there, that as the risk decreases, so the earliest stage is the seed investors, the highest risk, they actually require a higher return to compensate them for that risk. There are a number of common valuation techniques. We're going to talk about a couple in a little bit more detail through that, but these slides will be made available on the Sydney Angels LinkedIn page, so you'll actually be able to read some of these in more detail as you require as well. So let's talk about price and earnings, which is quite often used for a lot of companies, especially those that are listed. And the important thing for price earnings, you actually require positive earnings. And arguably, earnings can be distorted or manipulated depending on the assumptions that you actually make through that. And it doesn't necessarily take into account cash flows. Now, most startups don't have positive earnings, so it's really not possible to use a price earnings ratio to value a startup. Price to EBITDA. So this is a little bit better than the previous one because it's earnings before interest, taxes, depreciation, and amortization. It's much more closely linked as cash flow, but it still needs that number to be positive in order to come up with a multiple for it. It does ignore capital expenditure related items. People do adjust for that by doing an EBITDA minus CapEx calculation. But again, for a startup, this is much harder because you quite often still don't have positive EBITDA because you're really investing and trying to grow the business. Price revenue obviously requires revenues, but importantly doesn't require earnings. So you will very often see this referred to in early stage companies that are growing around that. It is a very blunt valuation technique. It doesn't take into account general profitability, unit economics, cash flow considerations. But if you have revenues, you can quite often get these numbers and benchmark them to other companies that are out there. The other one that most people are very, very familiar with is a discounted cash flow. It is an integrated and complete valuation measure. It does factor in when you have negative cash flows and positive cash flows, but it's very highly sensitive to the assumptions that are in there, the forecast, the discount rate, the terminal growth or exit multiples that you apply. Implied in that discount is a risk of failure. Now, importantly, the calculation, so whilst it's a potentially good methodology, it's usually done incorrectly by most people, and then they fudge it, and it always overstates the value of an early stage business. And what you'll actually find is people will do this exercise. It comes up with a number that's well above what they think the business is worth, so they make some adjustments to the discount rate to bring that down. So they start fudging it to actually come up with a number that they want the result to be, as opposed to being a genuine discounted cash flow calculation that risks the cash flows. There are some traditional methods which are really linked to the stage of the company, and it really ignores the industry-specific merits for a given team or whatever the proposal. So the idea of this one is, an idea stage, it's worth less than $500,000. You've got some first customers, it's worth somewhere between 1 and 3, and if it's sort of break even, it's going to be over $5 million. It is quite often used. There's a few more formulaic-based approaches on this, especially used by angels. And the key one is called the Berkus method, and we'll actually talk about the Berkus method and use an example of it as well. So what is the Berkus method? The Berkus method determines the valuation and puts it into sort of 5 buckets, which is the idea, the prototype, the quality of the management team, strategic relationships, and product rollout and sales. And what it does is it allocates $500,000 or up to $500,000 of value for each one of those. So if you have a sound idea and it's really strong, which is really addressing the risk that we talked about earlier, say what is the basic value, is there product risk, saying up to $500,000. If you've actually built a prototype, have some software, have the hardware, that obviously reduces the technology risk associated with it, and therefore you get more value added for that. If you've got a team of people around the business, more than one in particular, or one has got exceptional experience in it, that reduces the execution risk around growing the business, so you get more value for that. If you've got strategic relationships, this could be how are you going to get to market, supply, how are you addressing the overall market risk and competitive risks. Again, another $500,000 of value for that. And then product rollout or sales. So if you've actually got sales and you've actually started to roll out, that reduces some of the financial and other production risk. So you get to that. Now, so in effect, this applies the maximum value you can actually get is about $2.5 million, but you then make an adjustment for an industry or area. So if it's in a really large, huge industry, highly scalable, highly attractive, you would then apply some kind of multiple. You might sort of bump that up by 20 or 30 or 40 or 50% because of that. Now, this is a valuation technique that's very useful for very early stage companies that don't actually have revenue. So you can actually critically assess yourself against these criteria and then give yourself a score. Now, it will be very rare to come up if you haven't got revenues, you haven't got anything in market to be worth $2.5 million, but it gives you some kind of guidance around it. And there's lots of other alternatives on the web that you can actually find that use this similar kind of principle. Now, how do VCs work it? They've got one called, surprisingly, the VC method. What it really looks at is the money that goes into the business and looks at the money that goes out and the time frame across that. And therefore, it takes into account the time value of money. It uses that internal rate of return as a judgment to actually discount that future value back to today's value, and then uses that target outcome to generate the valuation. it also generates post-money valuations. Let me just go to the next slide. So if you have a look at this, and there's a little matrix here that says, so how do you use this? So if you had an investment here that on the top right-hand corner generated you a 10 times return, and you managed to achieve that in 4 years, that would generate an internal rate of return of 78% for the investor. If you still got that same 10 times return, but it took you 8 years to achieve it, that would be a 33% internal rate of return. Likewise, top left, 5 times return. If you delivered that in 4 years, it'd be 50%, 8 years, 22%. So you'll see that this sort of ranges between sort of 25 and 75%, and really 5 to 10 times is that sweet spot. And people are generally targeting sort of over 30% internal rate of return on those investments. Now, the other thing to bear in mind is everyone wants to build $1 billion business, and they do get built, but the vast majority of businesses get exited via M&A. M&A in Australia generally tends to be not $1 billion businesses, mainly because there's not a lot of people who can actually buy $1 billion business. And this is data from a few years ago, but it fundamentally doesn't change that much. What you'll actually show is about 2/3 of deals are done at less than $50 million. And about 17% of deals are above 150. This moves around a little bit depending on the sector and market conditions, but broadly, exits in that sort of $50 to $150 million range is that. So if you're going to do your forecast and say you're going to have $1 billion exit, it is achievable, but it's an outlier. How do you actually do these calculations? So if you assume if you assume the business is going to exit for $50 million in 6 years' time, and if you say, okay, I want to deliver a 25 to 35% IRR from that investment, that means the value of that business today is $8 million to $13 million, right? So if you were to invest today at $8 million and get an exit at $50 million in 6 years, that would have generated a 35% IRR. If you invested at 13 mil and exit for $50 million in 6 years, that would have generated a 25% IRR. Right? So these monies are post money. So if you were to invest $2 million into this business, the pre-money valuation of that business would need to be in the range of $6 to $11 million. And you can do this calculation. Now, people then say, how do I work out what my business is actually going to be worth at the end of that? What's my exit multiple? Right. What we actually do is you can actually go and have a look at listed companies and actually find out what they're trading on and use those as benchmarks. So this is data. There's a tool called FactSet that's similar to Bloomberg, and there's some other ones that do similar things. You can also gather this data yourself just by actually researching the companies and finding their financial statements and actually doing the calculations. But what you're tending to look on this one is the revenue multiples, because most startups will look at that. So this is a SaaS technology business group there. You got Elmo, Xero, WiseTech, Technology One, Nearmap, and Class Super. And the valuation ranges of those for FY21 range between 3.5 times revenue at the lowest, up to 16.6 times revenue at the highest. Now, when you're actually looking at these, it's important to understand the differences in the business, because that's a massive range between Class at 3.5 and Xero at 6.5. So some of the differences on those ones will be at a high level, the size of the market opportunity and the scale of that business. So you'll notice that the Class's revenues, for FY20 was 43 million, growing to 51 million. Xero's revenues were 680 million, growing to 770 million. So Xero's revenue growth in FY21 is almost 2 times the entire revenue expected of Class for FY21. So the size of the market opportunity has a big impact on it. Growth rates have a big impact on revenue multiples, and so do EBITDA margins. So how do you use this? You actually pick a multiple that you think is actually reasonable for the exit, and that's what businesses are trading at today. So when you look at what that trading is trading at today, and you say, okay, what's my business's revenue going to be, say, for example, in 4 years' time when I expect to exit? So if you think your business is going to be generating $5 million in 4 years' time, and you think you've got a big market opportunity, you're still going to be growing fast. So what I'm actually going to do is I'm going to pick a revenue multiple here of the average of, say, 9.5, and I'm going to apply 9.5 times to my 5 million of revenue. And that's what my exit valuation is going to be. You then take that number, discount it back to today's value using that VC method, and that will come up with an estimation of today's value. Now, there are lots of different ways to actually do it, and different stages apply. So in the early stages, you're going to be skewing towards price revenue multiples, price comparables. Price comparables could be so much per subscriber or so much per other metric that's available in your business. Looking at the traditional method, i.e. the Berkus method, and looking at discounted cash flows. And what you would actually do is you would actually look at all of these items and actually bring them together to actually inform you about what you think the valuation is. In investment banking, we have what's called a football field, where you actually plot out the different valuation ranges using the different methods. So if you look at this one, the DCF in this example has given a valuation of just over $15 million to about $17 million. The multiples has given sort of 9 to 11 and a bit million dollars. Comparables have given 6 and a bit to $11 million. IRR has said, what's that, 8.5 to 12 million, and the times money method has come up with about 8 to 11 million. So when you have a look at that, you then apply and say, based on all that information I have, what do I think my valuation range is for this business? It's probably in that $9 to $11 million range. You'll see the DCF off to the right. Remember I said earlier that DCF, if you do it properly, will always throw a higher valuation because you haven't actually proved a number of the assumptions around that. So if you go through and do the maths and the thinking through the valuation, you'll come up with a reasonable valuation range. So let's talk about some of the things that actually impact value. One of the things that we look at when we're advising companies on raising capital or on their exits is how do you think about what drives value and what are some of those measures. So some of the important things we talked about is the scale and growth of a business. So that is how big is the total addressable market. A bigger market opportunity is nearly always going to be worth more than a smaller market opportunity. So the bigger the TAM, the bigger the attractiveness of that investment opportunity. Growth is really important. There's a very strong correlation between growth and valuation multiples. If you're growing fast, you're going to get a higher valuation multiple than if you're growing small. If you're a small player in a large market, you should be growing fast. If you're growing too slow and the market is huge, it doesn't actually bode well. Now, how do your customers work? Network effect is really important. So if you can create a network effect in your business, so as in each customer that comes into the business adds value to the other customers, that can be quite powerful. So if you think about social networks, networking type things, telephones, communications, the more people you have involved, the more valuable it is to everybody in the network. If you can lock customers in, or there's a very, very high switching cost, that makes a customer sticky, their revenue stream more predictable, and therefore more valuable in the long run because you have a higher lifetime value of customer. Customer concentration is important. If you have a single customer that represents a large percentage of your revenue, that increases the risks associated with the business and is less attractive to investors. Then start looking at your operating metrics and your cash flow. So visibility and predictability. If you can have a good visibility of your future cash flows, that reduces risk. This is the reason why investors like recurring revenue businesses and SaaS type businesses, because it's quite predictable and it continues to grow. Organic demand versus marketing demand. If you have too high a reliance on marketing spend, your customer acquisition costs can change quite drastically. If a new competitor comes in and actually has just got more money than you, can actually spend more money on acquisition, your growth might decline. So you need to have a balance between organic and marketing. Capital expenditure intensity. If you spend a lot of money in order to grow your business, that's actually less attractive. So if you think about a telecommunications company that has to build a network, they have to incur huge amounts of expenses before they actually generate revenues. You may have earnings, but they need to convert into cash. If your business is growing, so for cash flows and earning conversion, if your business is growing, but that really means you have to tie up huge amounts of money in working capital, which could be accounts receivable or inventory, that's actually less attractive than a business that doesn't and need to do that. Your gross margin level, if you have a really high gross margin level, all your revenue growth effectively drops down to your bottom line and actually makes you more money and therefore is more attractive. This is why a high gross margin business with high revenue growth is actually very attractive to investors. And then the business model. So if you have a sustainable competitive advantage, highly attractive. If you can scale for a low cost, again, attractive. Um, your major partner dependencies, if you don't have big dependency on other people, that actually reduces your risk. If you only get your customers from a certain referral source, that introduces risk to your business and is less attractive. And optionality is one that not many people think about, but if you're a business that has a range of options that you can extend and expand your business by selling additional products to the same customer base or sell that same product into other markets very easily, that obviously gives you increased expansion capabilities. So it's actually, again, highly attractive to investors. Now, if we have a look and think about this one for the potential valuation using the Berkus method. So example of this one, this is a startup, had no revenue, product wasn't launched, but had a clear pathway for it. It had a great balanced team, had 3 co-founders. It's an Australian market. It's huge in the Australian market, and it's also strongly growing and consistently growing market. It's a very, very highly regulated market. It's a very sticky product. The lifetime value of customers is very high, and at scale, it's a very profitable business. It's a really competitive market. There's lots of people in this market, but the competitors' service is poor or fair at best. And they target an unloved segment of the market. So if we think about the Berkus method, we've got our 5 buckets: sound idea, prototype, quality management team, strategic relationships, and product rollout. So let's have a look at the sound idea. Looking at this, it's an established market, it's highly regulated. The product's not ready for launch, but they've got a clear pathway to it. And it sounds like they've got a good team. So we'll probably score fairly high on the sound idea. Prototype. Now, they haven't built it, but they've got the clear pathway. It's highly regulated, which means you think they've probably done some work around it, and therefore it probably scores reasonably well on that one. Quality management team. Well, we've just said they've got a great balanced team of 3 co-founders, so let's assume they would score quite strongly on that. Strategic relationships. Now, we probably can't tell that much from this one, but you would actually think about that. If you're the company, you would actually know this, and if you're an investor starting to do DD, you would actually start to think about that. So you're probably not necessarily on that information going to score super high, but you'll probably get some points. And then product rollout of sales. So again, a bit hard to tell from that, but so it's not going to be $2.5 million, but it's also going to be a lot more than $500,000 just for the sound idea. Now, do we adjust this one for industry or area? Given that we've said that it's a highly profitable business at scale, it's very sticky, it's a huge market, strongly growing, and it's regulated, we're probably going to give this one some points for scale. So whatever number you came up with on scoring your 1 to 5, you multiply some increase for that. So I said, this is really useful just to use this as a methodology to consider any business, especially anything that's early stage. Now, some things to remember when trying to determine value. Higher risk means lower value. If you have higher growth, that means higher value. The higher the quality of the business, obviously means a higher value. So think about barriers to entry, network effects, and other quality aspects. The unit economics and margins are important. And then you have to focus on the future because it's all about the future, but you have to be guided by the past. So if you do have things in the past, you should be taking that into account. Now, I said at the start, is it art or science? But at the end of the day, it's actually a combination of both art and science and market dynamics. So it is actually a negotiation. Both entrepreneurs and investors have to be aware of there are a range of valuation methodologies and measures that can be applied to the company, and you should actually apply multiple ones. You should actually assess which ones are actually relevant. You also need to think about what are the other factors that may impact valuation and how do you actually quantify that. And then when you're actually negotiating, think about the implications of various measurement techniques and terms on the actual contract that you actually put together. And we now we've got time for some questions. So there's been a handful of questions coming through. So I'll actually try to go through those. So one of the first ones is, what should I be doing if an investor or a group at the last minute tries to lowball after previously agreed, but in informal valuation? Should you walk away? Look, this is a really hard one. It's probably not a great start to the relationship for both parties. Um, um, my view would be it really depends on how desperate you are for the money, and can you still continue to work with the investor group around that. So if you're not desperate for the money and you have other alternatives, and you think you're in actually a strong competitive position, I would probably consider walking away from that. But I would have an open conversation with them about why they've changed the valuation and what's actually happened there. We would normally try to suggest as an angel have the valuation a portion of the valuation conversation as much upfront as possible, because that sort of removes that last minute one. But sometimes you do need to do a level of due diligence before you can actually get views on that. One of the questions: are other startups the only thing that a founder is competing against for capital? Look, no, I mean you've got to get through the gate in the first place to be able to have an investor interested in investing in the first place. But you have to remember that that investor is actually assessing multiple opportunities out there. A lot of startups only think about, if you're a software startup in the HR space, you're quite often thinking about other HR software competitors. The investor is actually saying, well, I could invest in this HR software, I can invest in this fintech software, I can invest in something else. So they're actually looking at other ones. So you need to bear it in mind, but you need to also run your own race. The question is, in assuming that both parties are knowledgeable, does that mean that Sydney Angels does not normally invest in deep tech or next-gen leading-edge ventures? Now, actually, Sydney Angels, so it tends towards broad tech, but we've actually done a number of biotech and very high-risk early-stage conceptual ones. Because Sydney Angels as a group is actually made up of almost 100 people that have got varying backgrounds and expertise. That's the part of the power for the Sydney Angels group in investing, because there's normally somebody in the group that has some level of expertise associated with it. Or if it's not there internally, we can go and actually get other people to actually help and contribute towards that. Do investors normally lean more towards B2B or B2C? I don't think there's a hard and fast rule. I think it depends. Both have pros and cons, and it depends on their background. Broadly, I think you sort of see a very broad cross-section of both B2B and B2C. B2B can be very attractive if you can work out how to sell the product, because quite often B2B is very sticky and has high lifetime value of customers, but quite often it's a slower. B2C can be more fickle, can grow faster, but is very, very heavily reliant on the product quality and marketing. The question is, the Berkus method is calibrated up to 500 for the US market. Shouldn't it be scaled down for this market? It was originally for it, but it seems to hold fairly true for the Australian market. So rather than US $500,000, we would talk about Aussie $500,000. Where it tends to be probably a little bit different is the scaling up. So there are a few other researchers who actually make some other variations to the Berkus method. Says, if you can get safe notes or higher early stage valuation from US investors, why should an Oz startup founder even engage with Aussie investors? So as someone who invests in both Australian ones and some US ones, I'd say actually a lot of US valuations are not substantially higher at the same stage. We see a number of people try to go and raise company in the US and then come back and raise it for Australia. The US is a much, much more aggressive market for competitors for startups. It's actually much, much harder to raise than what people think, and you often need to be there. It's changed a little bit in this environment. But at the end of all of it, I would say you should just talk to all investors. A high early valuation is not necessarily a great outcome. It can actually deliver a poor second stage. The question is, should I pay an advisor to help me with a capital raise? Will they help me with valuation? The answer to this really depends. For a very early stage company yourself, you really need to do the capital raise yourself. You can get advice from other people. I don't know that I would be paying for that advice. There are plenty of people who can actually help you and will actually give you general advice for that. At most, it would be an advisory board type role, but it should actually be more than just helping you with that. Do we ever invest in social purpose first and investment return second? I don't think anybody does social purpose first specifically, but there are impact investment groups that will actually do that. And we're done.